We want to be a platform that helps seniors live longer, healthier lives.
Today, my guest is my good friend, the CFO of AmeriLife, Jim Quinn. Jimmy, how are you today, buddy?
Doing great. Thanks, Al. I appreciate you having me on.
I'm very excited. We go back a long way, and I was very, very much interested to have these conversations. I'm sure the folks out there would love to hear all about your background at AmeriLife.
Yeah, I appreciate that. I think I was going through the math. I think it's 20 years now that we go back. We'll talk about that in a second.
Oh, easily.
My background, I'm CFO of AmeriLife. I've been here almost 9 years. Had been, prior to AmeriLife, I'd been at Olympus Partners for 10 years and Marsh for a couple of years, primarily doing deals in the insurance space. So it was, that's the best sector in the world and a great place to meet folks like you.
So, well, we actually met when you were in the PE world, right? And what a lot of people don't know is obviously PE has been in this space now since literally 1993. I think USI was the first one that had a PE in, but it was nothing like it has been in the last 13 years. Okay. But back, early 2000s, probably 2005-ish or so, we started engaging with Walter Harris and Richard Flater at Tannenbaum Harbor and Thesco to help them out. And obviously, played an instrumental role in assisting them in the transaction with Olympus Partners, which at the time was you. Okay, and we were ahead of our time, basically doing these deals. And since really 2013 is when it really started kicking. Really, it's in a much higher level. But that's where we first met, Jim, and we hit it off right from the get-go.
Yeah, that's a great trip down memory lane. I remember those days. Walter and Richard were terrific partners. They introduced me to you, so I'm grateful to them for that. At the very least, we were at the beginning of the boom, right? It was, yeah, you're right. There was some private equity activity in the PE in the P&C space, and the idea at the time when we bought into Tannenbaum Harbor and Thesco was to start to do a roll up and build that asset out. Ended up not, we didn't build it as aggressively. And then I actually spun out and went out on my own after that. But that was a great time to be, starting to invest in the insurance space, the distribution space. Walter and Richard were great partners to start with. And then you started introducing me to everybody in the insurance industry. I was just amazed at your Rolodex. And the thing I always appreciated was, you were so transparent, so upfront with people, and everybody was willing to take your call. So, the conversations you sort of teed up for me back in that day, we were trying to think about investments in P&C distribution. We're just really high-class individuals, great opportunities, folks like Mike Christian and Jeff McKernan. And I was just always amazed that everybody was taking your phone call, and I realized that I needed to take you seriously. And, it was fun. We got to spend a lot more time together chasing some deals, but also getting to know each other over Yankee games and, baseball games with our sons, and a lot of good memories from that era.
And we did. And, what we have in common, obviously, not only the insurance broker space is, you played Division I baseball. I played Division I baseball. We shared those stories. Our sons played. We coached both of our sons, through the years. And then, like you said, we're big Yankee fans. So, I'll never forget the one day we went to the game. We sat down the left field line in the first row. It was a day game. And I went home that night and I watched the replay. And all we could see is you and I down the left field line. Every time a ball got hit down that way, foul ball, anything, there's you and I. And it was amazing. And I remember that vividly. And appreciated, and very much appreciate the friendship that you and I have built beyond the business world. So this is, for me, all these podcasts, are really exciting because it's with people that not only have had great success with, okay, and I appreciate the kind words on all that stuff, but, also built these great relationships with. And it's nice to give back.
Yeah, well, great to be here. And I remember that day at Yankee Stadium, and we should do that again. Let's get back out to the stadium and root on Aaron Judge once he's back from the DL.
So well, you come up here, we'll jump on the golf course and then we'll go to the stadium.
All right, sounds like a plan.
It'll be a lot of fun. But that being said, Jim, I think the thing that really can come out of this podcast, and it's been very successful with all the podcasts, or every one of the ones I've done. This is the 22nd one in a year. We started last June, when as some of my competitors call me a social media star now. Now that I've done this 21 of them, you're my 22nd one. Bottom line here is it's been very grateful to do these. And I think the big thing that's come out of these for all sides, not just for our marketing for Sika Fletcher, has really helped all the folks and all the firms that have done these podcasts with me. They get a lot of traction out of it. I think AmeriLife is a great company. We very much enjoy working with you and trying to do different transactions, but you're a little bit different because you're not, doing everything. You're very niche oriented in what you focus on, and you do it really well. And it's a sizable business, and it's also, a private business still that, is probably a little under the radar in the world of insurance brokerage. So today's the chance for you to really give everybody a view of what AmeriLife is, what you're doing, et cetera, et cetera. And I think the folks out there would love to hear about it.
Yeah, I appreciate the opportunity. I love telling the story because it's a really good one. It's been a hell of a ride. I've been here, like I said, almost 9 years. I got recruited to AmeriLife by Scott Perry, our CEO, and his sales pitch to me at the time was, look, the P&C industry has started to consolidate rapidly, but nobody is really being aggressive consolidating in our space, which our space is primarily around health products like Medicare Advantage and Medicare Sup, as well as annuities and life insurance. So a little adjacent to the classic P&C employee benefits roll-up that a lot of the, that got the start to a lot of the roll-up strategies that were funded by PE. And the opportunity was, a really fragmented market. And honestly, at the time, better pricing for acquisitions for us as an acquirer back then. This is 9 years ago. Things have obviously moved on a bit since then. But AmeriLife, when I joined the platform, we were a little over $100 million of revenue and hadn't done an M&A transaction in about 5 years. And Scott really wanted a CFO who was going to be M&A focused and help kind of resurrect the acquisition strategy. And I think we both bit off a lot. We ended up biting off a lot more than we thought we would. It was I wasn't expecting the pace to go at the rate it did, and the success of especially those early days acquisitions that we did. It's been a lot of fun. So we're now over $1 billion of revenue. We've done about 100 acquisitions in that 8-year time period, and most of our acquisitions are partnerships. They are we're looking for folks who want to stay in the business. They want retain some of their equity and not just sell out 100%, and help us grow a business that we're trying to build into something powerful. The vision that Scott's outlined is, we want to be a platform that helps seniors live longer, healthier lives. And the products we have put onto our platform all do that. It's Medicare Sup, it's Medicare Advantage on the health side. It's life insurance to help, people with legacy planning. It's annuities and other wealth products to help people with, build their retirement nest eggs. So trying to bring together companies that can cross-sell those products, companies that are good at what they do, and most importantly, back to the first part of our conversation, doing it with people that we like doing business with, bringing on, what I call the all-star team, and, A players in their businesses that really can, that are fun to work with and share our vision for building a real premium consolidation platform in our space.
Well, it's interesting how you forecasted the direction you were going to take, because obviously the one thing that you speak to and mention multiple times is the Medicare, which is super hot, right? The aging industry that we're in on its own right, and people aging themselves. I just signed up for it 2 weeks ago. Believe it or not, okay? Not to age myself, I'm a young 64, but I'll be 65 in August. And, it's an eye-opener. And it's good to have an outlet for it. And there's a lot of people, we've done a bunch of Medicare deals out there recently over the last couple of years and continue to get a lot of it. And you're a great outlet for it because you understand it. a lot of your what would be your competitors, okay, there's not a lot of people that are like AmeriLife, but there's a lot of people that are out there doing acquisitions and insurance brokers that are full service. They do the P&C, the employee benefits. It's interesting that, you have a distinct advantage over them because you understand it. And that's a big thing, Jim, because there's a lot of it. And I think you're going to be a preferred outlet for it, and you have been to this point.
Well, and it's one of the things I like best about our model. I mean, look, I don't pretend we're doing God's work here, curing cancer, but we are doing important things for consumers that Medicare is a tough thing for a senior citizen to wrap their arms around. So having a trusted advisor, having an agent who knows the product really well, can help them understand what are their different alternatives. What are the different options as they're going through it? Like, I mean, you're the young end of the spectrum of folks who are going to be signing up for Medicare.
So I hope so.
And well, absolutely by law. But I look at the other end of the spectrum too. My mother's north of 80, and I wouldn't want her to have to go through that process alone of figuring out what her options are. I really like the idea that there are trusted advisors out there who are expert in the space, doing things in a compliant way, and are able to help the senior citizens actually make good choices. Because a lot of products down the road, if it's a commodity product, you don't need an advisor. You'll be able to just sign up online. But something like this, where you really, it's complex, it's sophisticated. It's nice to have your hand held as you're working through your options with an agent.
Well, the interesting thing also is that the products that you're focused on are the products that how they're paid from a commission basis from the carriers are different, and let's just call it a less recurring in some ways, revenue than the standard property casualty employee benefits. And it's funny, Jim, because, 10 years ago, no one would touch a life business. They didn't know how to value it. And, we were lucky enough to kind of break the seal in this market and kind of say, hey, look, here's the way you should value it. Because if you value it on the renewals, no one would do a deal, right? There's not enough there. You couldn't satisfy them. But we were smart enough to say, hey, look, why don't you look at how consistent the revenue is, right? And if the revenue is consistent each year, they're doing the same amount or more, that means the earnings are consistent. So you were able to value these things. Maybe the multiples weren't as robust as some of the more recurring ones, but you still could capture the full EBITDA. And that was the trick that we found. And the fact that you're doing that and have an outlet, there's still others out there that don't understand how to value it. So you do have a leg up on what you're doing. You absolutely do. And the other thing is your model is different. Your model's a little different. Your model is kind of a little bit more like the Broad Street / Keystone model that are doing all the P&C and all the different stuff, to where you not only hold equity in potentially the overall, which is similar to Keystone, they do both, but you also hold equity in your sub, right? You're investing in them like you're the PE almost, okay, directly. And that's unique. That's an interesting model. It's a good model, and a lot of people adapt to it, and it's not for everybody, but you are investing. It is a partnership, and that's different than a lot of the others. Although the others hold equity in the overall, so they feel like partners too. But maybe you talk a little bit about that philosophy on your model.
Yeah, no, you nailed it, and you made two good points there. I'm going to come back to the first one about the renewal revenue and things like that. But let's talk about the model first, because I think that's probably the more interesting one for the audience here. You said it's not for everybody, and I agree completely. I mean, that's the intent, right? We're not trying to be a take all comers kind of consolidation strategy. And so we've got intentionally a model that really appeals to an entrepreneur who wants to stick with their business, wants to keep growing it, wants to have maybe the upside of the platform, but really, gets more comfort with the equity that they own in the business that they know and love and they grew from scratch. And so, typically if we're doing a deal, we're going to buy less than 100%. So a good example would be we buy 60 and our partner holds 40% of that subsidiary, and it continues to operate, within the AmeriLife ecosystem. It's got access to all the resources, but it still operates as an independent entity. It's got the legal structure is still there, and in most cases we've maintained the brand, and we've always maintained the management team. Like this is a people business. We want the executives, we want those entrepreneurs to be sticking with us and helping grow the business. They're so important to the success of their business, number one, but also the overall platform as well. We want those folks to have skin in the game and to grow with us. We'll use our holdco stock occasionally, and typically it's in lieu of cash, or maybe it's maybe instead of doing 40% in the subsidiary, maybe they do 20% in the subsidiary and 20% with holdco stock. I like having the alignment with the holdco stock, but we're so big, it's really hard for any one individual partnership to drive results, to change our individual outcome. Whereas at the subsidiary level, at the partnership level, that guy or gal who owns 40% of his or her business can really make a difference and drive results. And we want them to have skin in the game at the level that they are actually, influencing the outcome. So it's been a great model. I think we've gotten what I would call selection bias in favor of, more entrepreneurial principals who've got more runway and want to work longer and really see the benefit of taking that second bite at the apple from their own business down the road. So, we like the model. We'll vary from it on occasion, and there's lots of different ways we can structure those partnerships. But to your point, we view them as partnerships. They're not for everybody. Somebody who wants to retire and step out of the business and, take 100% cash proceeds day one is not really going to be a fit with what we're doing. But, somebody who sees a vision for growing their business, but wants to de-risk it a bit, take some chips off the table now, help us grow it over the next 5 years. Like it is a model that's worked really well for some of our key principals, and we like the formula.
So Jim, as I've said on many of these podcasts, the equity is great, but it's only as good as the liquidity. How does one liquidate here? Since you're the competition out there with other private equity backed brokers, which you are, okay. Yep. Have these events. It used to be 3 to 4 to 5 years, like a clockwork, but I think the world's changed a little bit now. It may be a little bit longer hold, although people are still going out and recapping, and we've been involved in a lot of them. We'll be involved in others. How do you get liquidity here as a shareholder, as someone that sells into AmeriLife?
So for AmeriLife at the holdco, or for those subsidiary partnership investments, or both?
Both.
All right, perfect. So let me talk about the partnership investments first. So we do that 60-40 transaction. The person who owns the minority stake, the 40%, has the option to get liquidity when our PE sponsors trade, when we do the big Topco transaction. We've got a put call arrangement typically with those folks, and it'll get triggered at the time of a PE exit. I like that as the CFO. I like that because I can plan the liquidity around that. In order to pay for the shares that we would buy in from that minority partner, I've got to have access to capital. I've got to have my debt facility in place. And if we do that concurrent with a PE exit, it's a lot easier for me to arrange the financing. So that's the most obvious way. It gets triggered by a PE event, whether it's an IPO or a sale of a significant portion of our sponsor's equity. Then all of the minority interests we've got provisions in those documents to take either some of that out at that time or all of it out. Depends on how long the asset's been within our ecosystem. It's worked really well for the folks. We've had 2 PE trades already since I've been here. And, generally it's worked out very well. Everyone, the ones that have already been taken fully out, we still own those businesses and operate them. I think the other thing I would add on that part is, we do have some flexibility where there are times with, if we have extra capital, or we have a partner who's nearing the retirement phase and needs to get liquidity, we've been able to work with people on a one-off basis as well, sort of between the PE exits. So it's not, we're not basically saying, hey, you're going to be stuck in this for 10 years. We're trying to make sure that there is a regular kind of program of liquidity that they can access when, but it's contractually driven by the PE exits.
Well, right. So it's very similar to what everyone else is doing. It's upon the exit, upon the event, as we call it.
On the event.
Okay. which
And
is
then
nice.
for the holdco, for any of those partners who took holdco or for anybody else, I mean, obviously, we've had success. AmeriLife traded. We're on our fourth different generation of private equity sponsors. We've got great backers in THL and Genstar. Genstar came in 2022. THL came in 2020. Prior to that, we were owned by JC Flowers. So we've gone through every 2.5 to 3 years an event. Always unclear when the next one is. It's driven by company performance and external market factors. My focus as the CFO is to keep our head down, and we've got to execute so that when the market window's open and an exit is available, we're in good position to do it. So no visibility on when the next one would be. It's just that we're at a size now. We've got to be thoughtful about it. It's just like now we've got 2 main PE sponsors. We'll probably always have a syndicate of PE that will be need to kind of refresh the capital stack every let's say 3 to 5 years. And look, we're investing to professionalize the business. We want to have as many options as we can, because as the company gets bigger, the exits get more challenging. It gets more it's more difficult to pull them off.
Well, it's an excellent segue into my next thing. And by the way, you got good pedigree. Ryan Clark's a very good friend of mine from Genstar, and we've done a lot together, very successfully. Back to back to the days of Comfy Seguros to Alera to a bunch of stuff, and very, very fond of him. He's terrific at what he does. But that segues right into my next thing. You're $1 billion in revenue, right? And last year, a couple events took place that firms of similar size or a little bit bigger, right? That wanted to remain private, and ended up going out to the market, and finding out that these larger institutional investors viewed the market a little bit different than they thought from a value standpoint. So everybody thought they'd go out and maybe have another investor piggyback off their current investor. And, because when you get to a certain size, you can't do it with one investor anymore to stay private. Look at some of these that have the Canadian pension funds or longer holds or, all different things that are out there now. But, the way to get the real value out of it, was always to be able to do it with one. And when you get to a certain size, I think a couple people that went out got blindsided a little bit by the results, and they ended up selling to a public. Okay. How do you view that, Jim? I mean, you're probably on the front end of that in your role, that, you're watching the equity, you're watching, make sure that you can get to liquidity. It sounds like you've done a great job, because you've had several events, but they did as well. And when they got up there, and they were a little bit bigger than you, but not that much, to where now it may even scale down to, a certain size is going to force the hand to either try to go public yourself, which, means you need to prepare for a couple of years to do that. You need to be at a certain leverage point on your debt, so on and so forth, which, everybody's over levered to some extent, no matter what they say. So, is the plan here the next event? What's next for AmeriLife? You think you're preparing to do the public offering yourself, or trying to stay private and nimble and find a way to do that, without having to selling to a strategic?
Yeah, I appreciate the question. I love the way you phrased it so carefully and gently. Look, the world's definitely shifted a fair bit. If you look back 5 years ago, 10 years ago, all of us, the private equity backed insurance broker roll-up strategies, consolidation strategies, were benefiting from lots of tailwinds and lots of multiple arbitrage on the acquisition strategies. And, you were able to succeed through those levers alone. You did more acquisitions, you created more equity value, and there were other private equity sponsors to take the platform off the hands of the existing sponsors. I've made a big fuss around here that, we love our sponsors. As you mentioned, Ryan's terrific, Ganesh terrific, both firms, we really like them. But, who owns AmeriLife doesn't change the AmeriLife strategy, right? So whether it's private equity, public, different private equity firms, like we want to set this up so that the platform exists, the management team continues to operate on the same strategy, and with the support of the shareholders. But it doesn't, the strategy doesn't shift when the shareholder base shifts. So in order to pull that off, we have to really be focused on multiple exit avenues, to get the business ready for whatever could come down the pike. And, maybe it's a public offering someday, but really, for me, the biggest focus is about the integration activities. Like, I think, Al, I am no longer running our M&A effort because the business has gotten so big. We wanted somebody to be focused on the day-to-day on the M&A. And I spent probably more of my time thinking about capital strategy and thinking about integration of 100 assets that we've already, brought into the mix. And getting that right is critical to no matter which exit path we end up wanting to take, whether that's, selling to a strategic, selling to another private equity consortium, taking the business public. We want to have, sustainable kind of enterprise-wide systems that help our affiliates, help our agents, do a better job for their clients. And there's a lot of work that goes into that when you've taken 100 different firms and kind of brought them all together. So, making it sustainable and repeatable is a big focus of activity, and our investment dollars. And we think if we keep doing that and we do it well, we'll start to unlock, a little faster growth on the bottom line and the top line. But also that'll lay the foundation for an exit, whichever avenue ends up being, the most obvious or the most likely, given the market conditions at the time, whenever our PE sponsors decide that they want to take that route. My goal is, and I mentioned this to one of our shareholders the other day, my goal is to put that decision in the hands of the board so that they can decide when and how the exit needs to unfold. If we've done our job, we're not sitting there saying, hey, you can't do X, Y, and Z because we're not ready. We want to be ready no matter which path they want to choose so that they can pick the timing, and, we'll have a say in terms of, which, who the next set of owners are ultimately. But really, I don't want to be sitting there saying, hey, you can't go public or you can't do this because we haven't made the investments or done the work needed to lay the foundation to follow that route. So, we've got a plan and some dollars invested to make sure that we're in a position, if the market dictates that, an IPO is the best exit, if, however many years from now, we'll be ready for that when the time comes.
So there's three key things in my mind to be ready, to your point, right? And a lot of people that are getting ready have identified this and they need time to get there, right? What you're saying, which I think is brilliant, is you're doing it now as you go along, so you'll be ready for any one of the avenues. So there's three key things, right? Integration, obviously. That's, everybody wants to know that everyone knows you're acquiring, to gain scale. But, is it working, and is it all put together as one? That's number one. Number two is it generating the results from an organic growth perspective? You have to have good, strong organic growth. Okay. And the third thing is, are you watching your leverage multiple? Okay. Those are the three things that you really need to have ready to go, because I think there's people that want to go public that have one of those three things, maybe, okay, maybe two, but not all three. So what you're saying, Jim, which makes perfect sense to me, is you're watching all three of those things. You're being disciplined. A lot of people did a lot of deals, and listen, we've been the beneficiary of some of these things because, we go to the market with our sellers. We run a process. It's very competitive. We do the most deals in the country, right? Year after year. And there's a reason for that. We're still getting great values. People say, well, can you get me the best deal? I said, that's the easy part. It's really finding the right situation and the right fit, because it's not just about what you get up front at close. This is these deals are generational wealth creators. If you come to play and you come to grow and not just take your money and go fishing or golfing, right? All right. If you come ready to go, but it sounds like, Jim, what you're doing is you're checking the box on all three of these things as you go along, and you will be ready no matter what the market dictates at that time.
Yeah, I love the question. I love your framing of it. I would start with this. Like, my first day on the job here, that was, 9 years ago. One of the things I said to my team was like, we work backwards from the exit. Like, we're thinking about that exit. and
That's the
working
PE
backward.
mindset,
Yeah,
brother.
I
That's
mean,
the PE mindset.
I
Yep.
can't get rid of the 10 years of PE mindset. I got trained
No,
by
right way
some of
though.
the
It's
best
the
in the
right
industry.
way. No, it's the right way, Jim. You're
Um,
absolutely right.
so we're always thinking like that, and to the point where we've been investing in improving our controls and thinking about things like public readiness years before we even had this conversation. So it's just part of the DNA to get ready for these things. It doesn't mean we're going public. It just means I don't want to be the one to say you can't go public. I want to be the one to say, all right, if that's what you guys want, we'll be able to pull it off. I would add to your list of 3. I liked your list. I would add controls to that, although you could tuck it under integration if you want. The challenge for us, the managing the leverage ratio, we're good at that, and also we've got sponsors who are great at that. I'm not worried about that. The organic growth, we're doing a good job there, and we've generally outperformed from an organic growth perspective relative to our sectors. The integration's the challenge, and for me, the challenge that's unique to us is that entrepreneurial deal structure I talked about. We want to do the integration in a way that doesn't dampen the entrepreneurial spirit. We want to do we want to make things cohesive without losing the energy and the enthusiasm of the entrepreneurs. Again, this is a people business. We want to keep that spirit and keep that intact. So, we're being thoughtful, I would say, about how we're approaching things like integration and systems work. It's not just hey, we're just going to collapse all these entities together and declare ourselves integrated. It's got to be a lot more in-depth and thoughtful than that. And, I feel good about kind of how we're approaching it. But it's going to take some time. That's not a snap your fingers and you've got an integrated whole.
It's a balance, especially with your entrepreneurial model. You have to balance it, because if it appears that you're becoming corporate, that's not what these folks signed on for, right? If they're being sold partnership and they want to know that they have a say and a view and they're going to run their businesses, and you're trusting them to do that and giving them the support. But no, Jim, everything you said makes perfect sense. And I know you a long time, and I know you're very disciplined. And, you have to be disciplined. And it's hard because you want to compete on deals, right? And sometimes the deals you want the most, there's a lot of competition out there. The good thing for you is in your niche and what you guys do, you minimize the competition because of the type of businesses you're looking to buy. And I think, you're when you were told coming in by Scott that, that nobody's doing this when what we're doing, rolling up these, that was accurate. And you guys have done a great job of it. I mean, probably, I'm not saying people don't know who AmeriLife is. I'm sure a lot of people do, but I think a lot more people will after this podcast and what you're doing and your scale and your size and your strength and your expertise. But that's great. I think the other thing is, I want to know if you were surprised a little bit by the results of some of these events with these other firms that we talked about, that sold to the publics. I mean, the publics are trading right now at an all-time low, really, in the last, several years. And it's funny, I had both Pat Gallagher and Powell Brown on podcasts, loved both of them. They're great guys, great firms. And, both of them said, they were very candid, their stock was here, now it's there. The other thing we didn't talk about is the high interest rates. It was the Wild West for a while, okay, up until about, 2.5, 3 years ago. Now, people are getting a lot more selective because their cash is expensive if you have to get more. But, they were very clear on their drop in their equity and saying, in fact, Pat said, everyone should jump on this train now because it is going to come back. I mean, it's like the hula hoop. It's a fad. Right, it will come back, and a lot of that is driven by what's going on in the world, okay, what's going on in the marketplace, and certainly now this AI infusion that some people really buy into. It's going to change the industry. I think the only thing it will do is make people more efficient if they use it right. I don't think it's going to eliminate everybody's job or take over the relationships of the production people and whatnot. Like everybody thought technology would every time. In 38 years I've been doing this, that once technology is coming, there's no longer going to be this, there's no longer going to be that. This industry will never be replaced by anything like that. It's a relationship business. But, what were your thoughts around that? Where do you think you guys sit in the market. Were you a little surprised by those two, purchases to Gallagher and Brown? And where do you think you guys sit from a competitive edge on the M&A side?
Yeah, wow, there's a lot in there. And I'll start with that piece. You're always surprised, right? When a trade happens and it's not the direction everybody thought it would happen, like that's always a little bit of surprise. Where multiples sit in those industries, like those are the types of exits that are going to be available in today's market. And, that's, people need to have that flexibility. It's back to what I talked about earlier for us. We want to have all the paths open to us. Multiples being where they're down from their peaks, right? Like, is that a challenge? Is that a problem? Like, I view it as an opportunity. Like, this is, multiple, it really only matters, when you sell. Like, so having a period where multiples are lower when what will fix those multiples? What will drive them back up? Better organic growth, better integration, more recurring revenues, better acquisitions. Like, it's all about execution for me. Like, we, head down on executing and the multiple sort itself out. That'll put us in better position competitively as well to make sure that we're the acquirer of choice in our niches. I feel good about where that sits. This is a good time to be investing in the business, to be investing in systems and standardization of procedures so that we can, scale the business more effectively. Because and without multiples kind of, lifting back up a little bit, this is a good time to invest. I'd rather be investing than selling at these prices personally. So, feel good about that. Your take on AI, I think, is a fair one. Like, we've been wrestling with that. What's the impact? How are we going to use it in our business? And, I think my general takeaway, as not an expert in that field by any stretch, but it really needs to, for us, I'm expecting it to be a productivity enhancement on steroids. And, but I don't see it just replacing what we do. Like the hand holding, the people, the advice, our target market is not going to be core users of AI. I really view it as a productivity enhancement that we need to tap into and get it, have it be part of what we do rather than a replacement for anything we do. And I'm really looking forward. We started to unlock some of that internally in the back office. And use it to make our agents more efficient, make our wholesalers more efficient. It's a huge opportunity. It's amazing to me what it can do. I'm sure a year from now it'll be, even more impressive. Is there a crossover point where it really has, negative impacts on labor and the economy as a whole, or, things like that? I'm not the one smart enough to know. That the one thing what I told my team about a week and a half ago in a different forum was, with all of those tools coming online and all of the resources in AI and automation and the computers and systems we have, to me, it just feels like the value of human interaction is going up because it is becoming a little more scarce. People working from home, people talking to their advisors over the phone or over Zoom instead of in person. Like, the value of working in person with someone and meeting your client in person or meeting your colleagues in person, for me, the scarcity of that is making the value go up. And I appreciate every opportunity I get to sort of interact with M&A targets or with my team here. I don't want that to be replaced by AI or anything else anytime soon. And maybe I'm a little old school on that, but I'm holding out for the idea that AI is going to support what we do, not replace what we do.
Yeah, I agree with that 100%. And just to be clear, what we've seen so far is the multiples have gone down on the larger transactions, the larger firms. It hasn't really dipped at all on the day-to-day transactions that we're doing. And that's not with us trying to drive the multiples up. That's just running a good process, a good competitive process, and let the market speak. Because everyone's got capital. Most of them are private equity backed, right? For the most part, there's 50 or so private equity backed firms at this point. And the funny thing is that you run a good process. People need to win some deals. So people that aren't winning that often, are going to come to play when they need to come to play, and want to win that deal. So the thing that's changed, Jim, most has been the selectivity of what you bid on, right? When the interest rates were low, you know, 10 people see it, 9 or 10 bids for sure, no problem, right? Interest rates got high, people are a lot more select, which has made it an easier job for us because we try to get to the one anyway, you know, and when you have lesser bids, but usually the bids that are coming are the people that they like, the seller likes the most and the buyer likes them the most. So it works out anyway. You know, you kind of weed people out quicker in this because, you know, they're going to take their shots and spend their money where they think it's most warranted. And that's, you know, the difference really now. But we haven't seen it trickle down here. I mean, I'm sure people are trying, you know, and just like the pandemic, everybody called me on a Saturday. I must have been on the phone 10 hours when nobody even knew it was a Saturday, right? Because everybody was home and all the days were blending in together.
You're on the phone 10 hours a day anyway. So that wasn't
no
that wasn't a unique thing.
Yeah. Well, now on Zooms, we did those added to the phone work. But other than that, that was like everyone wanted to know in the pandemic what's going to happen. And they all want to know if the multiples are coming down. And I said, I don't know. Are they? Why would they? The money's still here. Yeah, if you're insuring restaurants and school buses and whatnot, yeah, you might have some problems, but nothing really changed. We did a recap, you know, March 31st, 2020, you know, right in the middle of it. And, you know, never affected anything. You know, people tried to use that as leverage to maybe cut the deal better. But the bottom line here is, you know, I think this industry continues to consolidate. Every time I look at something, people told me 20 years ago, wow, soon there's going to be nobody left. What are you going to do? And I said, well, I'll deal with that at this problem. Every time I turn around, it seems like there's more and more that's happening. New things are happening. But, you know, it's been a great run, certainly for myself and for me. And, you know, we're going to keep going. I got a lot of really good, talented people as partners, and I want to see them create the success and the wealth that I have at this point. But, you know, Jim, I think what you guys are doing, you're at the top of your field in your expertise and in the type of products you have. You know, I only can congratulate you because I know you've had a huge impact on this business. It's obvious. And I'm not surprised at that because, you know, I've always felt that you were, you know, really good at what you did. Even back to when we first met with Olympus, you know, you could tell that you were a high quality individual and were committed to your craft. And I think that's what it takes. You know, if you work hard and you focus, I tell my own children, I tell my people, you know, no one can stop you or impede you from how hard you work, right? No one can do that. They can maybe control other things, but not how hard you work. And I give you a lot of credit for what you've done in your career and what you've done for AmeriLife. It's amazing. And we are very committed, Sika Fletcher, to continue to try to work with you and help you continue to build this business and build this brand.
Well, two things. First of all, I'm not going to take all the credit because the AmeriLife platform has been terrific for me. It's been a good match with what I can do. Scott's been a terrific supporter, and the deal flow that we've generated as a group throughout the executive team has been terrific. But it's it's been fun. Scott had a vision, and it's been fun to go execute on it, and it's really rewarding to see it all come together. But right back at you on the congrats. I mean, you work harder than anybody in the industry, and always sticking up for your clients. I've always enjoyed working with you. I am delighted to see the success you guys have had, and the years you've been over 100 deals a year. Just mind blowing to me. It's just so much effort and so much good work going into it. So it's been fun to watch your story evolve over the last 20 years as well. So I appreciate the partnership we've had, the support, and the fun we've had working together.
Well, listen, I thank you for that, and I appreciate it. And it's the biggest thing is the friendship, Jim, because I've made such good friendships in this space with people. And to me, as you've heard on every one of these podcasts, it's all about the people for me, right? It's all about people and everything you do, really, when you break it down. And when you lose sight of that, you really lose sight of what you're doing in life, in my opinion, because I'm a people person, you're a people person, we enjoy each other, and it's been a great run. It's been a great success. I think I covered everything today that I wanted to. Is there anything else you'd like to cover before we wrap?
No, I think that's perfect. I enjoyed being on. I appreciate you having me on, and it's good to get get your perspective on these issues. I appreciate you letting me share mine.
No, it was awesome. And I thank you again, and let's keep rolling.
That sounds good. And we'll get up. I'll get up to New York. We'll do that round of golf and the Yankee game.
Sounds good to me, buddy.
All right, buddy. Thanks.
Thanks again.
For more information about your unique situation, please contact Sika Fletcher or visit us at www.sikafletcher.com. All opinions expressed by the host and guests are their own and are not necessarily those of Sika Fletcher. This podcast is for informational purposes only and should not be relied upon as professional advice. Sika Fletcher employees and clients may have positions in the firms discussed in this podcast. Any information provided is subject to change and does not constitute an offer to purchase or sell any financial product. Sika Fletcher LLC does not underwrite securities, nor advise on, nor affect transactions in securities for the account of others.